Thank you very much, Andrew. It's a real privilege to be here, sort of helping provide some context. I must admit, I'm not a shipping expert at all. I have, very little knowledge of the shipping industry, but I'll try to sort of set the stage for you from a macroeconomics, geopolitical standpoint. Clearly, you can see, I think, we're calling this clouded by geo-economic uncertainty. So geopolitics and economics have played a very profound role over the last few years, and I suspect that will continue to be the case. If anybody thought, I'm just going to sort of take a quick pause and talk about what happened 2 years back. Asia was under the impression that there is no inflation problem here. There's an inflation problem in some parts of the world, but certainly Asian central banks did not see any inflation. And then we had the Russia-Ukraine situation, and overnight, you had food prices spike, you had oil prices spike, and from being complacent about inflation, perhaps being relaxed about inflation, central banks were overnight behind the curve. And I think that's something that happens, and I think we have to pay attention because that is very, very profoundly linked to how the economics and the geopolitics work today. Now, we are looking at a global environment which is perhaps not as healthy as one would like to see. If you think about major parts of the world, they're not necessarily performing as strongly as one would expect. Certainly emerging markets is doing quite well. You can see Asia is actually doing quite well, and Asia definitely continues to stand out as one of the strongest regions from a growth standpoint. The Middle East is doing very well, and that actually helps create two major anchors within the emerging market spectrum, which have actually aided even the shipping industry. If I think about developed markets, I think developed markets are not performing very well. Europe obviously is extremely weak, so is China. When I think about this part of the world, China has not necessarily performed at a pace that we've been used to from China, and the dividends that you get from a global growth perspective have been missing. I don't think that's necessarily going to change over the short term. So I think that's clearly been an ongoing theme for global growth. But when you have growth in the context of 3% or thereabouts, which is what we are seeing from a global growth perspective, that's not healthy growth, that's low growth. And so that's the context with which we are working. Now, when I think about what we expected at the beginning of the year versus what we've had so far, US has been a lot more resilient than we would have expected. The US economy has done a lot better than most people would have expected by now. And even last year, I think the US managed to perform stronger than a lot of people thought the US was going to do. China has clearly been one of those areas that there has been some amount of concern, sort of it been in line with what people had expected this year, perhaps a little underperformance versus what we had expected. But Asia and the ASEAN region, continue to be actually quite strong on a relative basis in the global map. Let's talk a little bit about the US, because I think that's a major economy. It is obviously performed very well, as I just said, but clearly there are signs of the US economy moderating. When I think about the labor sector, I think this is perhaps one sector that everyone will pay attention to. You are seeing clear signs of the job market weakening. Now, it's not falling off a cliff. It's not something which is alarming at this point, but this tends to be self-fulfilling. So once you start seeing labor market weaken, you start seeing consumer sentiment weaken. That really has a knock-on impact on how the consumers operate, which will clearly have an impact on the economy. And thereafter, you start seeing a bigger sort of move on the labor side. And that's something that we'll be watching for. Labor for far too long through this entire period has been very strong. Now, a lot of it has been because companies have tended to hoard labor. We had the COVID experience when obviously for other considerations, companies showed a softer side and kept staff on board. But we've seen since then, because it's very hard to replace good quality labor, people have actually tended to employ people, and that's actually resulted in excess capacity perhaps in some of the companies. And if the economy starts to moderate, this is one of the sectors which will get impacted. Apologies, I can't really see that slide. So from a consumer standpoint, if you look at the chart on the right-hand side, you can see that consumption is now starting to moderate somewhat. Again, when we think about COVID, the US, and like other countries as well, consumers got a fair amount of assistance that resulted in excess savings getting bumped up. And we've seen that being deployed in the consumption market, some revenge spending that took place out of the US and in other parts of the world. So we've seen very healthy consumption in the US. Now, if I break it down, it's very clear that if I look at the higher end of the population, the excess savings levels are roughly comparable to 2019. So they have come down versus where we were, but still very healthy. And they have more capacity to perhaps spend. So the US consumer perhaps does have more room to continue to spend. But if I look at the weaker segment of the population, the excess savings level is dramatically lower than what it was in 2019. And that's where you're starting to see delinquencies, you're starting to see credit card defaults, you're starting to see car loan defaults, you're starting to see more pressure build in the US economy. Overall, I think the economy is doing okay, but there is a story of two halves clearly. The areas which are more sensitive to interest rates are also seeing more pressure, and obviously the residential sector is one that the one thinks about. New home sales are obviously under pressure. If you're a young person coming out of a job market, out of the university, entering the job market, you're not looking at a 6% mortgage, you're looking at an 8% mortgage. And even if you chose, and if you're happy to take an 8% mortgage, the bank is not going to give it to you because you're not a good credit, you don't represent good credit. So I think that's clearly a challenge for that new home market. It's what has pushed these young potential buyers into the rental market, which again has created its own challenges, because that means that the rental market has been very strong. And as a result, that has been one of the stubborn factors that the Fed has looked at all this while, which has meant that inflation was higher than you would have wanted because the rental market was so strong. Now, once the rental market starts to soften, you'll start seeing more room for the Fed to cut. And I think now we are obviously embarking on that rate cut story. Inflation is coming down. I'll talk a little bit more about inflation, but I think inflation is broadly on trend to reach the context that the Fed would like to see. We probably get to 2.5% by end of next year. I think we are very much on track. This allows the Fed to move. Fed's focus has shifted exclusively from inflation to inflation and the labor market. And when the Fed starts getting more worried about the economy slowing down and the labor market weakening, that's when you start seeing more, more preemptive, proactive stance on the part of the Fed in doing more rate cuts, which is why we got that 50 basis points earlier this month. Europe, like I said, continues to be weak. I think the European economy has found it really hard to really come out of this low growth environment that it finds itself. Forward-looking indicators do suggest more pressure, and obviously they've had some pressures right next door in the form of Russia-Ukraine war to deal with. The energy impact of that has been very profound on Europe. That clearly has been a big challenge for Europe. Now, I think the challenging part for ECB more than the Fed has been stubbornness in inflation. Europe actually faces low growth and relatively stubborn inflation. That's a very difficult combination for a central bank. You want to respond to the low growth, but you have your hands tied behind your back because the inflation is actually still a problem. Now, good news for Europe, I think you're starting to see some signs that the wage contracts that they've actually managed are bringing wage pressures lower, and you're starting to see profitability for European companies becoming a bigger issue. You're starting to see some closures happen. I think the ECB is more likely to respond to those considerations going forward, and in inflation coming down with those wage contracts will give them that pass and will give them that room to cut rates. They're not going to be as aggressive as the Fed, but we will see similar moves from Europe as well over the course of the next 18 months. I think has been a very important story for the world. We are used to seeing China actually provide growth impetus to the world at times when the US and Europe have actually not performed well. This has been a very different story. Obviously coming out of the COVID crisis, consumer sentiment took a hit, business sentiment took a hit, and we expected more in terms of policy measures from the authorities in China. We've seen very nuanced policies. Now, I can understand why they've done that. I mean, they feel constrained on an overall leverage basis, and clearly the focus has been more on equitable growth and other factors rather than growth itself. So there is a thought process behind that, but the challenge for China right now is there are major anchors of the Chinese economy which are not performing well. Housing market. And this, and so investment. So I think there is a very deliberate stance on the part of the Chinese authorities to move away from investment to consumption. Now, it does not necessarily happen overnight. It happens over a period of time. There is clearly a transition happening where Chinese consumers are taking more of an active role in that economy. But what we have done, what we have seen coming out of COVID is the Chinese consumer has been weak. Chinese consumer sentiment has been weak because there's been job losses. They've been moving from higher wage jobs to lower wage jobs. And so a lot of things that have gone against the normal story that we've seen out of China, which clearly has impacted that sentiment. It's impacted business sentiment as well. And as a result, China continues to be extremely weak right now and is not providing the positive growth dividend that it's been doing for other parts of Asia, to the commodity market, to global growth more broadly. So I think that's been a big challenge for the world. There are lots of countries in Asia that have benefited from that trade. There's this China, and so obviously geopolitics has added to that whole mix, and depending on who comes to power after the presidential elections, we could see a little bit of ratcheting up of that risk. But even irrespective of who comes to power, I think there is going to be that geopolitical pressure. The US-China relations will continue to put some amount of pressure on the economic functioning of that country. So I'm going to actually move through these slides in the interest of time. When I think about inflation, I think inflation has been coming off, but there has been some considerations that one has to look at. Geopolitics has played a very important role. Routes from the Middle East have been impacted. There have been other sort of issues that have come to the fore which have clearly created cost pressures for a lot of companies. Obviously China's supply chain has been a major factor on that particular front as well. Both of these resulted in price pressures going up, central banks facing additional challenges on the inflation front. So I think those are things that I think clearly have been additional consideration for central banks to look at. Good news is they're coming off. These were the positives from a tailwind standpoint all through last year and early part of this year. We saw a commodity-based price positive tailwind, meaning commodity prices coming off. We saw food prices coming off, again giving a positive tailwind to the inflation debate. So I think all of these things helped. But I think we've seen the end of that story. We are not necessarily seeing more in terms of the benefit come through from that side on the inflation front. From here, the grind lower is going to be slow. It's going to be dependent on how the economy performs, how the labor market performs, how the rental side performs, particularly in the US. So I think those are going to be important considerations as we look forward on the inflation story. What I would say is that when I think about central banks around the world and what they are facing in terms of real rates are high today because inflation is starting to moderate, and everywhere central banks have taken rates to a decently high level. Asia perhaps not as much, but in other parts of the world they've actually moved interest rates quite a bit. So that means real rates are actually relatively high, and that becomes a bit of a sort of offset against the economy, and that should make economic conditions moderate going forward. This will force central banks to start cutting rates over a period of time. Now, markets are actually expecting a front loading of this rate cut path from the US, from ECB, and other central banks will follow suit. I don't think any central banks around the world away from these two will cut rates very aggressively, but they will have more room to cut rates once you start seeing the ECB and Fed cut rates. And that sort of will give other central banks room to cut rates. The FX pressure that comes from having very high US rates for other emerging market countries is no longer a factor. The other factor which actually benefits emerging markets when you start seeing the US start cutting rates is US money market rates start coming lower. If your money market rates in the US are at 5% or 5.5%, there is no interest for that money to fly into emerging markets at that point. It's only when money markets actually start coming lower that money starts to go into other asset classes because they start offering better returns from a risk-adjusted basis. Now, coming back to the US and Europe, our expectation is 75 basis points of additional rate cuts this year. So that means 125 basis points of total rate cuts from the US this year. Front loading of rate cuts in the first half of next year, which means one rate cut of 25 basis points every meeting in the first half of next year. That's 100 basis points in the first half of next year. And then probably one more rate cut in the second half of the year. Now, this is based on our expectation that the Fed wants to be proactive. The Fed is a little bit concerned of the possibility of hard landing. No one wants to talk about hard landing. Everybody thinks that we will get this soft landing. In my experience, I've been doing this for a few years now. If you have that level of interest rates and you have kept that interest rate for that long, that adjustment is never smooth. So I would not bet all my money on a soft landing scenario because I think that the market is pricing, and you're seeing the equity markets price that, credit markets are pricing that, risk premium is pricing that. I think that may be too premature. We are not quite out of that hard landing scenario, but the Fed is responding quickly now that inflation is coming lower and the labor market is starting to show some signs of weakness. The Fed thinks it has room to start moving fast, and that's how it's going to respond. If the Fed starts moving like that, I think it gives perhaps less pressure on the dollar to continue to appreciate. The dollar actually starts to at least trade sideways to lower, and that will give other EM currencies more breathing space to sort of trade on its own idiosyncratic bias. I think last few slides from my side, I think global trade has actually been performing quite well despite what I would say is not a very strong economy. In Asia, the semiconductor space, the electronic space has really benefited or given support to this entire trade story. There's broadening out of that trade. So that's really helped the trade dynamics. Very, very beneficial for Asia. But if you have a US moderating somewhat, Europe weak, China weak, you can't really have trade being super strong. So I think there are limits to how strong we will see the trade to be. The good news, if I think about this, is the strength of the South-South trade is picking up. Whereas traditional channels of trade obviously have been disrupted somewhat by policy, by regulation, by a whole host of factors, the South-South trade between emerging markets, within Asia, between Asia and the Middle East, in other parts of emerging markets, that's starting to pick up. And that's a very good sign because that suggests a much bigger and broader, growth over a period of time. Once we see a recovery in the major economies, I think you will see a much healthier dimension to this. I think clearly, as I said, Asia is more vulnerable if he gets a trade slowdown or if we see more regulatory pressures coming between the US and China. That clearly impact Asia more. This is sort of, a lineup of who gets impacted most with those kind of issues, regulatory pressures or from a trade slowdown. And the last thing I want to highlight is this. I think fiscal spending has actually played a very important role when we think about interest rates being raised by such an extreme level by the US, by Europe, many central banks, and global growth still being in the context of 3%, not lower. Perhaps at some point, some countries doing much better. That's largely because of the fiscal. Fiscal has actually come in and aided the economies and provided a very strong degree of support to the economic story. Now, the challenge is, if you look at the story on the right-hand side, debt to GDP becomes a constraining factor. And any country that has a major debt to GDP issue, either they will have to monetize their debt over time, or that will be a constraint to their economic growth going forward. We are seeing that in China. Are we going to see that in the US? And I think that's a question. Perhaps I'll leave it at that and sort of let you think about that, and perhaps through the course of the day, perhaps you'll reach some other conclusion on that. Thank you very much.